right, welcome back everyone. In this video, we are talking through the cash flow identity and we are about to get a little bit mathy. So yeah, the cash flow identity, very important concept here. So it's going to be putting together a lot of information in terms of operating cash flows, changes to long-term debt, interest, stockholders' equity, like dividend payments to stockholders. It's going to be putting together a lot of different things, but we are going to start slow, make sure that we are building up these concepts so that they cement in our brains, because I want people to understand conceptually what the hell is going on, as well as what the equations are that we're going to use. So we want to make sure that we understand both of those. So using the logic of A equals L plus SE, we can think about that from the perspective of cash as well. So we have A equals L plus stockholders' equity or owner's equity. We can think about it as cash flow that is generated by assets, okay, for the company, okay, for the company. So like cash flow that goes to the government would not go into this. So we're actually, still subtracting off taxes. We'll get to the nitty gritty details of the equation in a second. But cash flow that can be generated by assets is equal to cash flow that is going to go to creditors plus cash flow that is going to go to stockholders. Okay. Now, those could be negative sometimes, could be negative cash flow that's generated by assets, could be negative here, could be negative here. But there are some like inflows and outflows. But broadly, this very first thing that I want you to think about is that the cash flow that is generated by assets is equal to the cash flow that's going to go to liability holders, so cash flow to creditors, plus cash flow that's going to go to stockholders equity cash flows. Okay. Just very broadly, we're just taking that A equals L plus SE, and we're breaking it down as cash flow that's generated by assets equals cash flow that's going to creditors plus cash flow that's going to stockholders. So really all of the cash that's available and freed up to go to creditors and stockholders. That hasn't gone to the government. That's not tied up in purchasing new assets. It is freed up and it is available to go to creditors and to stockholders. Now we can break that down a little bit more, is how we calculate those cash flows that are generated by assets. So cash flows that are generated by assets, it's going to be operating cash flow. It's going to kind of be our starting point. So our company earns some operating income. We make a couple of adjustments. So we take EBIT, we subtract off taxes because that's going to the government, right? That's not going to be cash flow to the organization or to the company, because that's going to the government. We add back depreciation because that's a non-cash expense. That's our operating cash flows. And I break this down a little bit further even down here. But for right now, operating cash flow, that's kind of our starting point here for our cash flows generated by assets. So operating cash flow. And then we subtract off a couple of different things that represent that cash is tied up either in new fixed asset spending, or some cash is tied up in working capital changes. So like increases in inventory or increases in accounts receivable that we didn't actually get cash. Okay, so if we have increases in some of these asset accounts, that's actually going to tie up cash. Okay? So we take our operating cash flow, we subtract off both of those items, which again, I will break down even further, but this is going to be the cash flow that's generated by assets. And that's equal to cash flow to creditors plus cash flow to stockholders. Breaking down each one of those, these are more just like line items. There's kind of like some change in sort of numbers that we might have to pick out on a balance sheet. But this cash flow generated by assets, lots of calculation versus this is minimal calculations. And we'll see that when we put it into practice over the next couple of pages. But breaking this down further, cash flow to creditors, we're going to take interest payments, because interest payments, we are paying that to our creditors. Okay, that is cash flow that is going from the company to the creditors. Because remember, interest is connected to things like bonds. So when we have bonds, right, we have interest that we pay on those bonds. So those interest payments go to our creditors. So interest payments to creditors. And then we are going to add, because more money that goes to those creditors is if we retire bonds. So if we retire bonds, that means that we make them go away. Say that we've got $100,000 of bonds on our books and we want to make those bonds go away, so we no longer pay interest or whatever, right? Well, if we pay $100,000 for those bonds, to make them go away on our books, that is also cash flow to creditors. Okay, cash flow to creditors. So we're going to add some bond or notes retirement, but then we would subtract if there's new issuances of bonds. So if there are proceeds from new issuances, this is basically, we subtract off if there are increases in long-term debt. So if there's an increase in long-term debt, we go from 50 up to 55,000. Just to make numbers easy, if we go from 50,000 of bonds payable up to 55,000, that means that we actually received money from bondholders. We received it. So it's not cash flow that's going to creditors. It's actually the opposite of that. Cash flow coming from. That's why we subtract off any increases in long-term debt. Okay, cash flow to stockholders. It's going to be dividend payments. Our stockholders, the owners of the company, get cash in the form of dividend payments. So cash flow to stockholders. And then we're going to add if there's any stock repurchases. So if we see that our common stock account goes down, that means that we repurchase some stock. Okay. Or we're going to subtract off new issuances of stock. We can kind of summarize this or make this a little bit easier on ourselves. This is just if, some terminology is given to us like this. We are really taking the dividend payments, and we are subtracting off whatever the change in common stock is. So if common stock goes up, right, that means that we issued new stock. So dividend payments minus that increase. If we had a stock repurchase, we would take dividend payments minus common stock would actually be going down. So this change would be negative. So we'd be subtracting a negative, which is this positive. Okay. So again, that's like conceptualizing all of that stuff. We are going to put this into practice, I promise. But yeah, that's us breaking down that equation a little bit. So a couple of notes about some of the items above. Operating cash flow equals OCF, right? OCF is operating cash flow. But here are the steps here. For operating cash flow, we're going to do EBIT from our income statement. We're going to start with revenue. We're going to subtract off all of the things to get down to EBIT. We're going to subtract off taxes. Okay, we're going to subtract off taxes, and we're going to add back depreciation. So EBIT, working down our income statement, we're going to subtract off taxes. And a little bit of an aside, sometimes we are just given taxes, but then other times, to find taxes, we have to take EBT and multiply by the tax rate. So that just means we're going to find taxes, we're going to take our EBIT, we're going to keep working down our income statement, do a little side quest, take EBT, multiply by our tax rate. That's what we plug in ours as taxes. Okay, then we're going to add back depreciation. And there we go. Here we got net capital spending. Net capital spending is basically money spent or tied up, money tied up to buy fixed assets. So we're subtracting that from operating cash flow for these cash flows generated by assets. Starting with our operating cash flow, how much is the firm generating? But then we subtract off, oh, there's some cash that's tied up in buying new fixed assets. Okay. So an equation that we can do is net fixed assets, new minus net fixed assets, old, plus, so just the change in net fixed assets. Think about this as the change in net fixed assets. But it is the change in net fixed assets plus depreciation. That is the overall capital spending. Overall equals net capital spending. And in the real world, you might see net capital spending as something like CapEx. So CapEx spending, capital expenditures. It's just saying, what is the money that's tied up in purchasing fixed assets? Okay, so change in net working capital. So really, I mean, these things taken together, you could just memorize this. I don't really like to memorize things too much, but here's kind of what's going on. So if we have PP&E, just like one more little quick thing about this net fixed assets and depreciation thing. If we have PP&E, this is gross fixed assets, okay? What I mean by net fixed assets is when we subtract off accumulated depreciation. So let's say that we've got going into a year, so the start of the year, we've got 10,000 in gross fixed assets, so property, plant, and equipment, and we've got $1,000 in our accumulated depreciation account. That means that are net fixed assets are 9,000. Okay, net fixed assets are 9,000. Let's say that throughout the year we buy $3,000 worth of property, plant, and equipment, and then we add $1,300 of accumulated depreciation. Okay, we add 1,300 of accumulated depreciation. We're still just depreciating over a straight line, whatever. You don't really need to know that, but just know now we've got 13,000 and 2,300. So new net fixed assets are 13,000 minus 2,300, which is 10,700. So you might say, okay, the amount of money that we spent on fixed assets is just 10,700 minus 9,000, 1,700. Okay, but that's not the end of the story. It's actually 1,700 plus this depreciation expense for just this year. So it's really going to be, this is the 1,700, but we have to add back depreciation because that actually wasn't a cash amount. So here, that wasn't an amount. There we go, 1,300, and we end up getting 3,000. Okay, as the cash that we actually used to purchase new property, plant, and equipment. So part of this net fixed assets went down because of this depreciation, but we bought $3,000 total of PP&E. So that's how much money we actually spent or was tied up in purchasing fixed assets. So that's what we've got going on here when we're saying net capital spending is really what was that change in gross fixed assets. But the reason that we have to do this equation of net fixed assets new minus net fixed assets old plus depreciation is a lot of times that's all that we're given. So if we're just given line items for net fixed assets, we have to do the difference in net fixed assets plus depreciation. Okay, difference in net fixed assets plus depreciation. If we were just given gross fixed assets, we could just say, well, how much money was spent on gross fixed assets? That $3,000, that's the number that we want. Okay, but net capital spending is how much is tied up in purchasing fixed assets. All right, moving on before we jump into a few practice questions is change in net working capital. That is net working capital new minus net working capital old. Okay, net working capital new minus net working capital old, which is going to be current assets minus current liabilities new. Okay, current assets minus current liabilities new minus current assets minus current liabilities old. And that's just going to be numbers that we have to be able to pick out from a balance sheet. Okay, current assets minus current liabilities for each of 2 different years. Now you could rearrange these terms and do current assets minus current assets and then minus current liabilities minus current liabilities, but that is, not recommended. I do not recommend doing that. Here we are just going to do it this way. Net working capital new minus old, and yeah, should be good to go. All right, so the practice questions as promised, we are going to jump in and just start cranking away. We're going to put all of that together. So let's say that we need a little bit of help. So GPA Factory, we're trying to get a little bit of help sifting through our futuristic business plans. All the numbers are, I don't know, it's 20,000, 22,000, but all these numbers are in billions, That's how well we're going to do in the future. Numbers are in billions. So we got $20,000 billion in 2026 and $22,000 billion in 2027. We are going to be rolling in the dough. So we got to assume a 20% tax rate. And then we got a series of questions. So we've got these questions on this page, and then we've got a couple more the cash flows to creditors, cash flows to stockholders. So really a lot of this type of exercise stuff is going to be working down our income statement. We can get that. We're going to break down exactly how to calculate operating cash flow. And then ultimately that long kind of formula or long kind of multi-part steps here for cash flow generated from assets. Cash flow from assets. And then we're going to set that equal to with our cash flow identity, the cash flow to creditors and the cash flow to stockholders. Okay, so just getting our feet wet here, we are asked for EBIT, and we're going to do that for 2027. So EBIT for 2027, let's get to it. This is just us working down our income statement. So we want to get to earnings before interest and taxes. So whenever I'm, saying earnings, I mean net income. Earnings before interest and taxes means net income before I have subtracted off interest and taxes. So we're taking our revenue and we're going to just start subtracting off everything until we get down to only things that we haven't subtracted are interest and taxes. We do have to know the difference. This is what we have to bring in from accounting. We have to know what our expense items are. So expense items are going to be depreciation expense, cost of goods sold, other expenses, and interest. But again, we are not going to subtract off interest yet because we want to get down to EBIT, earnings before we have subtracted off interest and taxes. So for the time being, for 2027, we are going to take 22,000 revenue. We're going to subtract off the 2,100 of depreciation, the 4,900 of cost of goods sold, and the 900 of other expenses to get 14,100. Now the order on an actual income statement is going to kind of matter. So we're going to do sales minus COGS first, and then we would subtract off, other expenses. Then we'd really have EBITDA, earnings before interest, taxes, and depreciation and amortization. So EBITDA is a lot of times used in the finance world. But there we go. We would subtract, but it doesn't really matter for this case because we know that we're subtracting off to get down to EBIT. We're subtracting off all three of those items. Just remember, dividends not an expense. No, that's paid in after-tax dollars. Okay, so we've got that EBIT. Now, operating cash flow. Operating cash flow is EBIT minus taxes plus depreciation. So it is our operating income, but then we're subtracting off how much we're paying to the government because that's not going to be held on to by the company. And then we're adding back depreciation because it's a non-cash expense. So we've already got our EBIT. That's going to be the 14,100. And now we can subtract off taxes. Well, using that EBIT number, we've got to get down to earnings before taxes, because our earnings before taxes, as we're moving down our income statement, this then multiplied by our 20% tax rate tells us we're paying 2,600 taxes. Okay, so we get down to our EBIT, keep things organized, then we're going to add back our depreciation expense that we know is 2,100. So we got 14,100 minus 2,600 plus 2,100, and we get 13,600 as our operating cash flows. And we are moving right along. So now, cash flow generated from assets. That's going to be our operating cash flows minus our, CapEx. So I'm just going to say change in capital spending minus our change in net working capital. It's not really a change in, capital spending. It is just capital spending. But the way that we do this is, again, that change in net fixed assets plus depreciation. Yeah, so operating cash flow, we already know that's the 13,600. We're going to keep our stuff straight with some brackets. This is definitely going to be an exercise in staying organized. But here we've got net fixed assets new, which is the 55,000. Minus net fixed assets old. So that's our change in net fixed assets plus depreciation expense, which is the 2,100. Okay, that is all of our capital spending here. Okay, that's all of our capital spending. And then we're going to do change in net working capital. Now, change in net working capital is going to be new net working capital minus old net working capital. But remember, new minus old is going to be current assets minus current liabilities minus current assets minus current liabilities. So this is just net working capital new. This is net working capital old. So it's just change in, but this is why I said that staying organized is very important, because it does start getting a little bit squirrely with all these negatives, but really it is just, staying strong, staying confident in breaking up that equation. So this one's not too bad. 55 minus 51 is 4, plus 2100 is 6100. And then follow me along, follow along with me. Follow me along. I guess, yeah, I don't know. Follow me along this way. Okay. Current assets minus current liabilities, new. So that's going to be for 2027. Current assets minus current liabilities. So current assets, we have to be able to identify what those are. That's going to be cash, current asset, that's accounts receivable. And this one's sneaky, hiding at the bottom, inventory. So cash, accounts receivable, and inventory, we're going to add those up. We got 7,000, 17,000, 32,500. So adding up those 7, 10 plus 15,500, just add them up. 10,000 plus 7,000 plus 15,500. We got 32,500. Okay, that's current assets. Then we're going to subtract off current liabilities. Current liability. I just punched my camera in the face. Current liability and accounts payable, current liability. Okay, so we're subtracting off each one of those. Okay, so because we're really subtracting off, let me just go down here, subtracting off the sum of all of our current liabilities, which is the same as just subtracting off each one individually. So minus 1,200 and minus 5,000. Minus 1,200 minus 5,000. We get 26,300. All right. So this 26,300, and again, this is where I say like do some. That's 26,300. Do these intermediate steps and like get what your calculations are, just in case you have to like redo your math, you kind of slightly mess something up, whatever the case may be. Just write down those intermediate steps. Then we got current assets 6,300 plus the 8,000 plus the 14,500. So 6,300 plus 8,000 plus 14,500, and we get 28,800 as current assets minus 1,300 minus 4,500. Minus 1,300 minus 4,500. We get 23,000. Cool. We're going back down here. We got 23,000. Okay, 23,000. Now we have net working capital new minus net working capital old. And that is 3,300. So then overall, we are going to take our operating cash flow, 13,600, and we're going to subtract off 6,100 and 3,300. We get 4,200 as our cash flow from assets. 4,200, and we can circle that and move on to the last couple of questions. So cash flow generated from assets, $4,200. Moving over to cash flow to creditors. Now, really, cash flow to creditors is going to be probably a little bit easier to see based on the information that's given. And then for cash flow to stockholders, we can use the identity, the cash flow identity, because we already have the cash flow generated from assets. So cash flow generated from assets should be equal to cash flow to creditors plus cash flow to stockholders. So cash flow to creditors, we're going to say that that's interest, right? Because when we pay interest, that's going to go to those creditors. So interest is 1,100. And then we are going to subtract off the change in long-term debt. Okay. So I will make sure to explain this, but we've got long-term debt goes from 21,000 up to 25,000, right? So an increase of 4,000. So we take this 1,100 and we subtract off that increase of 4,000. Now you could put it in parentheses if you wanted to, 25,000 minus 21,000, but know that it is an increase of 4,000. So we're subtracting off that change. And again, just so you have it, 25,000 minus the 21,000. That's what we're subtracting off, right? That 4,000. You're like, why is it negative? You're like, why are we subtracting that off? Well, the reason that that's negative is because if we had long-term debt go up, that means that we issued more long-term debt and received that cash from creditors. So it's actually the opposite of cash flow to creditors. It's negative. It's actually cash flow coming from creditors. So as far as how much cash the creditors received, they got the interest payments, but then they actually gave us 4,000. So it's negative to them, right? It's negative to those creditors. So here we take 1,100 minus 4,000. We got negative 2,900. Okay, now cash flow to stockholders. We know that the overall cash flow generated from assets is 4,200. We've got negative 2,900 is cash flow that is going to creditors plus cash flow to stockholders. Cash flow to stockholders. So we can just add 2,900 to each side. So we add 2,900, 4,200 plus 2,900 equals 7,100. So cash flow to stockholders equals 7,100. Now there might be other questions, and this is where kind of practice problems are going to come into play. There might be other questions that you have to deal with, knowing more, I guess, line item by line item, accounting for what happens to stockholders or cash flow to stockholders. That's going to be, just a couple of different ways to think about it. There is going to be dividends minus the change in common stock. Okay. Or, and then, there's some, math identities that are involved here, or it would be net income minus total change in stockholders' equity. But then that's, kind of smuggling in some retained earnings stuff, but there's a few different things, a few different ways to kind of look at that. But really it's just going to be, this should be equal to dividends minus change in common stock. Okay, I kind of said a little bit differently, and this will be the last thing that I say in this video, and I will send you on your way to the next video so we can keep this moving. But dividends minus this change in common stock, it's really dividends. And then if common stock goes up, that means that we issued more shares and received cash from stockholders. So if common stock goes up, we actually are subtracting an increase in common stock because we issued new, right? New issuances means that we actually got cash from stockholders. That didn't, that wasn't cash that was going to stockholders. Or we would say dividends plus whatever the decrease in common stock was. Because if there's a decrease in common stock, that means that we have, repurchased those shares. We repurchased them. So that's conceptually what's going on there. And this one, this is more of a, oh, we can use this identity, this cash flow identity to figure out the cash flow to stockholders. But in other sorts of practice questions, there could be ones that we have to work through and that we definitely have available for you to try out, where we have to be a little bit more detailed and specific about how we are generating or how do we account for the cash flow to stockholders. So that is it for this video. Definitely a little bit of a long one, but very, very important, very mathy. Take it easy. We'll see you in the next. Thanks for watching that GPA Factory video. Hopefully that was extremely helpful. If you found it to be helpful or to kind of clarify some of that content, you can also have access to a free month of membership if you follow this link and use the code YouTube100. Now with the GPA Factory membership, you'll have access to weekly review sessions that are 1 to 2 hours posted every single week that come with practice questions to help you along with your studies and have video solutions to those. In addition, it'll include an exam review as we get closer to the exam that'll have even more practice questions and video solutions to those given out as well. You also have 24/7 access to our question wall if you get stuck while you're studying, and you get discounts on private tutoring. So if all of that sounds great, again, go to this link and use the code YouTube100 to learn from one of the best to ever teach this course. That's me. So try it out, see if you like it, and yeah, we'll see you around. Thanks.